Stop laughing. Seriously, stop laughing at the headlines. While the mainstream media is cracking jokes about President Trump trying to buy Greenland again, while they are interviewing outraged Danish politicians and making memes about ice sheets, the risk managers at JP Morgan and HSBC are not laughing. They are screaming. Because buried in that tweet, hidden behind the absurdity of purchasing a frozen island, is a single sentence that just effectively nuked the global silver market. It is Sunday, January 18th, 2026, and the world of globalized silver just died. Here's the reality the news anchors are missing. President Trump didn't just threaten a trade war over real estate. By announcing a 10% tariff on all imports from the United Kingdom starting February 1st, he didn't just tax tea and wool. He inadvertently, or perhaps brilliantly, placed a 10% tax wall right in the middle of the Atlantic Ocean. And for the bullion banks that rely on moving silver back and forth between London and New York to manipulate the price, this is a death sentence. To understand why this is a catastrophe for the banks, you have to understand the game they have been playing for 40 years. It is called whack-a-mole. When the price of silver gets too hot in New York, COMEX, the banks fly metal in from London, LBMA, to flood the market and crush the price. When London runs dry, which is happening right now because of India, they fly metal from New York to London to refill the vault. They constantly shuffle the same bars back and forth to create the illusion of infinite supply. But that game relies on one thing: frictionless trade. It relies on the ability to move a bar of silver from Heathrow to JFK and back again without penalty. That ability just vanished. If this tariff goes into effect, any silver that leaves the US for London can never come back without paying a 10% penalty. Think about the math. At $90 an ounce, that is a $9 tax per ounce just to bring your own property back home. In the low-margin world of bullion trading, a 10% hit isn't a loss. It is bankruptcy. So what does a bank do when it realizes it can't bring the metal back? It stops sending it. Effectively immediately, the United States border has become a one-way valve. Silver can come in from Mexico, from Peru, but silver cannot leave for London, because if it leaves, it is stranded. It is exiled. We have a name for this in the commodities business. It is called the Roach Motel effect. You know the slogan, roaches check in, but they don't check out. Well, welcome to the new American silver market. Ounces check in, but they don't check out. This morning, every logistics team at every major bullion bank is issuing a stop-move order. They are grounding the cargo planes. They're canceling the shipments meant to bail out the London exchange. They are realizing that the 4.2 million ounces withdrawn from the COMEX on Friday, metal we thought was leaving the country, is now likely stuck here. This transforms the United States into a massive strategic hoard. It inadvertently secures the domestic supply chain for Tesla, for Raytheon, and for the US Mint by making it financially impossible to export our wealth. But for London, for the LBMA, which is already bleeding physical metal to China, this is the moment the lifeline gets cut. The cavalry isn't coming from New York. The bridge is out. And when the markets open tomorrow morning, the algorithms are going to try to execute a trade that is no longer physically possible, a mechanism called the EFP that acts as a teleporter between markets. But I'm going to show you why the teleporter is broken and why London is about to starve while New York feasts. We need to get technical for a moment, but I promise to keep it simple. Because if you understand this one concept, you will understand why the banking system is about to seize up. We need to talk about the EFP, the exchange for physical. In the minds of modern bankers, silver is not a heavy metal that you have to put on a ship and sail across the ocean. To them, silver is digital. It is a line on a spreadsheet. They believe they have a teleporter. The EFP market is the mechanism that allows a bank to instantly swap a silver position in London for a silver position in New York without actually moving any metal. It is like having money in a checking account and a savings account. You just transfer the digits. You don't drive to the bank and move cash from one vault to another. They tell you the market is liquid. The reality is, the market is lazy. For 40 years, this teleporter worked because the cost to move physical metal was negligible. If the price in London got too high, a bank could sell the EFP, promise to deliver metal in London. And if they got caught short, they could just put bars on a plane from JFK to Heathrow for a few cents an ounce. The physical reality was always there as a backstop, so the paper teleporter was trusted. But President Trump's 10% tariff just smashed the teleporter. The 10% tariff is not a shipping cost. It is a blockade. If a bank uses the EFP to swap metal from New York to London, they are now taking on a liability that they cannot mathematically cover. If they are forced to physically settle that trade, if they actually have to move the bars, they face a 10% loss on the return trip. This breaks the algorithm. The computer models that run the silver market assume that friction is near zero. Suddenly, friction is 10%. When friction hits 10%, the machine stops. Banks will stop quoting EFPs. They will stop offering swaps. And when the EFP market dies, the connection between the COMEX, New York, and the LBMA, London, is severed. They are no longer two rooms in the same house. They are now two different planets. This leads us to the terrifying concept of basis risk. In finance, the basis is the difference in price between two related assets. Usually, the price of silver in London and the price of silver in New York trade in lockstep. The spread is pennies, but starting tomorrow, we are looking at the birth of a super spread. I want you to think about the oil market. In oil, we have WTI crude, American oil, and Brent crude, European global oil. They are almost the exact same liquid, but they often trade at vastly different prices. Why? Because pipelines get clogged, because tankers can't move fast enough, because geography matters. Silver is about to have its WTI versus Brent moment. Here is the setup. London, the Brent of silver. The LBMA is starving. Inventory is critical. China and India are draining the vaults daily. They are desperate for metal. New York, the WTI of silver. The COMEX is now a Roach Motel. The tariff wall keeps the metal trapped inside the US. Inventory is building up because it cannot leave. They tell you there is one spot price. The reality is, we are about to have two. We are going to see a bifurcation. We could see silver trading at $90 in New York, where supply is trapped and plentiful, and $115 in London, where supply is non-existent and panic is setting in. And here's the kicker. The banks cannot fix it. In the past, they would buy the cheap NY silver and sell the expensive London silver to close the gap, arbitrage. But they can't do that anymore. The 10% tariff eats the profit. So the gap widens and widens. For a hedge fund or a bank that is short the spread, betting that the prices will stay together, this is a widowmaker trade. It blows up the balance sheet. This is why the risk managers are screaming. They are realizing that their entire global hedging strategy, which assumes they can net out positions between London and NY, is effectively insolvent. They are naked long in a trapped market and naked short in a starving market. Now let's look at this from the perspective of the US government. The media thinks Trump is just fighting over Greenland, but whether by accident or by 4D chess design, this policy is the most aggressive act of resource nationalism since World War II. We need to integrate a new piece of data here. Last year, the US Department of Energy updated its critical materials list. They finally admitted what we have known for years. Silver is critical for energy security, but they didn't have a plan to secure it. The US Mint was having to bypass the law just to get enough blanks to make silver eagles. This tariff is the plan. It effectively acts as an executive order for a strategic silver reserve without needing Congress to pass a bill. By making it punitive to export silver to the global hub, London, the administration has forced the metal to stay home. Who benefits from this? Tesla, General Dynamics, Apple, the US solar industry. These companies consume massive amounts of silver. They are terrified of a global shortage. Now, the government has essentially told the bullion banks, you can't sell our silver to China via London anymore. You have to keep it here for Elon Musk. The Roach Motel ensures that American industry has a stockpile while the rest of the world has to fight for scraps. But there is a catch, a nasty little detail that is going to hurt the retail buyer in America. We have to talk about refining capacity. The United States mines silver, but we don't refine enough of it. A huge percentage of the 1,000-ounce commercial bars are refined in, you guessed it, Europe and Canada. If the 10% tariff applies to all imports from these nations as a punishment for the Greenland dispute, then the cost to replace the stock of silver bars in the US just went up by 10% overnight. Even if the raw ore is here, the finished product often comes from abroad. This creates a strange paradox. The paper price in New York might lag because of the trapped inventory of existing bars, but the premium on new bars will skyrocket. If you walk into a coin shop to buy a fresh bar, the dealer has to pay the tariff to import it. So the dealer passes that cost to you. We could see a scenario where spot is $90, but the physical price for a 100 rows bar is $120. Not because of a shortage of metal, but because of a tax on purification. This validates the two-price system we discussed in part 1. The spot price becomes a theoretical number for trapped legacy metal. The street price becomes the real cost of replacing that metal in a trade war world. If you are waiting for the spot price to go up before you buy, you are missing the point. The premium is the real inflation gauge. We have talked about New York being the Roach Motel. Now let's talk about the burning building across the ocean. Let's talk about London. The London Bullion Market Association, LBMA, is the physical hub of the world. It is where the big industrial deals are settled. But as of this morning, London is an island under siege. For the last 3 years, we have watched a relentless drainage operation. India and China have been vacuuming silver out of the London vaults. We know that unencumbered inventory, the metal that isn't already leased or owned by an ETF, is effectively zero. London has been surviving on a lifeline, the ability to call New York and say, "Send us 10 million ounces, we are running low." Yesterday, President Trump cut the phone line. So what happens when the markets open in London? We are going to see a local default, not a bankruptcy declaration. They won't admit it that openly. It will look like backwardation. Backwardation is a technical term that signals a physical emergency. In a normal market, silver for delivery in 3 months costs more than silver for delivery today because of storage and insurance costs. But right now, traders in London are paying a premium to get silver immediately. They are rolling their contracts backward. They are selling March contracts to buy January contracts. Why? Because they don't trust that the metal will be there in March. They are grabbing the chair before the music stops. They tell you the system is robust. The reality is, London is a bank run in slow motion. This triggers the unallocated panic. Millions of investors hold unallocated silver accounts with London banks. They think they own silver. They don't. They own a claim on a general pool of metal. When news of the U.S. export ban hits, those investors will rush to convert their unallocated credits into allocated bars. They will want their name on a specific bar. But there aren't enough bars. The game of musical chairs ends when 100 people try to sit on 10 chairs. London is about to find out exactly how many chairs are left. Finally, we arrive at the mechanism that sends the price vertical. We have to talk about the banks, the commercial shorts. For decades, the big bullion banks have managed the price of silver by holding massive short positions in the futures market. They sell paper silver to cap the price. But they don't just gamble, they hedge. Usually, if a bank is short in New York, they are long in London. They bet that the price difference, the spread, will stay stable. It's a low-risk arbitrage trade that allows them to print money. The tariff just blew up the hedge. If New York silver is trapped, cheap, and London silver is starving, expensive, the spread doesn't stay stable. It explodes. It goes from $0.10 to $2,000 to $20. If you're a bank holding a spread trade and the spread widens by $20, you don't just lose money, you lose the firm. This is basis blowout. So what does the risk manager at the bank do? He screams, "Close the positions, get us out." To close a short position, you have to buy. The banks are not buying because they like silver. They're buying because they're terrified of the spread. They are forced to exit the casino because the table is broken. This removes the ceiling from the market. For the first time in 40 years, the silver price will not have a JP Morgan or an HSBC standing above it with a hammer. Without the artificial suppression of the paper shorts, silver will be free to find its natural equilibrium. And in a world of inflation, AI demand, and closed borders, that equilibrium is not $90, it is hundreds of dollars higher. We have arrived at the conclusion. The world of silver that we woke up to this Sunday morning is fundamentally different from the one we lived in on Friday. We have deconstructed the Roach Motel logistics, proving that the U.S. border has transformed into a one-way valve that traps inventory inside the country. We have analyzed the broken teleporter, the death of the EFP market, which severs the pricing link between New York and London. And we have exposed the London default, revealing that the LBMA is now a starving island cut off from its only lifeline. The verdict is stark. President Trump, by OSS executive order, has reintroduced the laws of physics and geography into a market that had forgotten them. The era of a unified, frictionless global price is over. We are entering the era of bifurcation. In this new era, the price of silver will not be determined by a global algorithm. It will be determined by where the metal sits. Metal inside the United States is now strategic inventory, protected, hoarded, and premium priced. Metal in London is stranded liability, disconnected from production and facing a bank run. The banks know this. That is why they are panic buying the spread. The government knows this. That is why they built the wall. Now, you know this. So what do you do when the walls go up? Here's your battle plan for the coming crisis. Step 1. Location is the new counterparty risk. In the past, we worried about who held our silver. Now you must worry about where it is. If you own unallocated silver in a London vault or an ETF that stores its metal in the UK, you are in the danger zone. You are holding a claim on a trapped asset. If you are in the US, possession is safety. The government has inadvertently rigged the game in favor of the domestic holder. Bring your metal home. Geographic diversification is dead. Step 2. Ignore the spot price illusion. Tomorrow morning, the screen might show you a confusing number. We might see a massive gap between markets. Do not let the volatility shake you out. The spot price is now just a math error, an average of 2 broken markets. Value your stack based on replacement cost. Ask yourself, if I sold this ounce today, how much would I have to pay to get it back with the new 10% tariff? That is the real price. Step 3. Hold for the super spread. The tariff on the UK is just the first domino in a shift toward resource nationalism. Every country is going to start hoarding what they have. Mexico might be next. Peru might be next. We are returning to a world where hard assets are the only collateral that matters. The banks are leaving the short side of the market because the risk is too high. Without the shorts, the ceiling is gone. Hold your position. Do not sell your ticket to the only lifeboat that floats. I want to leave you with this. The media is laughing about Greenland because they think we are living in a world of politics. But we are living in a world of finite resources. The walls of the prison just got higher, and for the first time in history, that is good news for you. Because the silver isn't locked out. It is locked in. And it is locked in here with you. The bankers are trapped in the Roach Motel. You are the one holding the keys. The financial media will keep reading the press releases. They will tell you it's just a trade dispute. We are here to show you the forensic accounting of the collapse. We know there are copycats trying to steal our work, using AI avatars to mimic this analysis. But if you want the original research, if you want to stand with the few who understand that the logistics have snapped and the price is next, then make your voice heard. Go to the comments and type "Staying with the Original." Subscribe and turn on notifications. The bridge to London is burning. Watch the fire from the safety of the high ground. I'll see you on the other side of the open.